This is a video about a paper on valuing private equity investments strip by strip with me, Arpit Gupta, and Stijn van Nieuwerburgh. So our paper is about trying to develop a new methodology for asset pricing applicable in contexts when the assets in question are not necessarily publicly traded. So with existing publicly traded assets, there is a whole standard set of methodologies that rely on factor analysis. So how do publicly traded assets returns co-vary with the returns on other publicly traded factor assets like value or momentum? Our project generalizes this approach in ways that can be applied to other kinds of assets that don't necessarily need to be publicly traded, for which instead there is information on cash flows. Private equity is a very good application of this because with private equity investments, you have an LP, some investor that makes some sort of commitment to a general partner who invests this money on their behalf and returns a stream of cash. What we want to know is how risky is that amount of cash? Did the investor wind up making money overall, taking into account the risk composition? To do so, our project develops a framework for doing asset pricing, which revolves around the measurement of a lot of dividend and capital gain strips, the analysis of how those strips co-vary with the cash return by private equity investors, and a further analysis of how private equity delivers or does not deliver alpha to investors, taking that into account. So our paper has a GitHub page, GitHub arbitrage dividend strip, that includes all of our code as well as our paper itself. What I'm going to do in this video, though, is run you through some analysis that illustrates our general methodology. So this is an R Markdown, which I've just set up by loading a few initial libraries. I'm sharing here the link to the GitHub page. And I'm starting off with just a few files that are going to load the core dividend strip data that we're going to talk about first, private equity data that we'll get to next, and then finally the combined data set that's going to be ready for regressions and other analysis. Also just loading here a couple of other helper functions and lists. So to get started, we're going to start by discussing what are dividend strips and how can we understand them. So this is a framework for understanding factor analysis by which we are going to be able to connect the risk attributes of cash flows against those of a variety of different factors that we've broken out into different horizons with these dividend strips. So just to make this concrete, let's start off by looking at the growth dividend strip that we're going to have here in this overall data. So we've got all of that here in this dividend strip file. So this is going to be a matrix that's accessible on our GitHub page that is going to collect together all of our different dividend and capital gain strips for a variety of different factors. And so we're going to start off with the growth dividend strip. So that's going to be here. It's going to be from this data set this is going to be the data set here. So I'll just take a look at what we have. All right, so this is a matrix in which the rows correspond to vintages and the columns correspond to horizons. So the vintages start in 1974. And what this means is starting from that time, suppose that you had an investing strategy that consisted of buying growth stocks. So you go out and put together a portfolio of growth stocks. This is measuring the dividends that you receive for each of those horizons that are roughly comparable to a zero coupon bond of the same maturity. So what that means is if I had the same analysis for a zero coupon bond, I would have a matrix of just ones. That would correspond to the $1 I get if I invest some capital today and then I don't earn anything until the terminal period and then I get that $1 payoff. Here, though, I'm doing a similar kind of stripped analysis, but instead looking at the risky series of dividends from growth stocks. So this first entry here, I'm buying these dividends, buying these growth stocks, just waiting a quarter, and then collecting the dividends. And so this is the dividends that I get from one quarter down. And similarly, for the second entry, that's buying all the growth stocks today, holding for a couple of periods, and that's the specific dividends that I get just from that period. So if I just buy a portfolio of growth stocks, I'm actually collecting this stream of dividends every single period. But by breaking it up into each of these different horizons, we're going to better match specific dynamics of when exactly cash is returned back to investors. But this here is just taken directly from the data. We're just mapping out the distribution and the timings of when these dividends are actually returned to investors across different vintages. So, kind of looking across the time series and across different horizons, how far we're looking forward in time. To make this concrete, we're going to take this data set here, and our first goal is to just sort of translate that into a graph that's just going to show you how exactly these dividend growth series are evolving over time. So we're going to focus specifically on one particular vintage, so the 1990 vintage, and we're going to see how the dividend series for growth stocks evolves for a initial starting point of that time. So we're going to first just kind of clean up this data set. You can just kind of see it's a matrix here. So we're going to use the R framework here of this kind of little command here. So this is sort of a chaining command that sort of allows us to start with this data set. And we're next going to do a variety of things to it. So first, we're just going to turn it into a data frame. So all this is going to do is take this initial matrix here and just convert that into a data frame object. Then we're going to create this vintage term. So that's just a row number here. Then we're going to actually convert this data set from wide to long format with the gather command. So that's just like reshape int data. And so we're going to refer to this as growth. We're interested in the cash flows. And if we look at the number of columns here, you see we have 64 columns corresponding to 64 quarters that we're looking at after each initial time period. So we're going to allow this to vary from 1 to 64. And this kind of vintage goes from, starts at 1, but we want to convert that to a starting date of 1974. So I'm actually just going to call that a vintage quarter. So I'm going to set this so that the first entry now is renormed to 1974, and it's adding up sequentially in quarters after that. And then I'm just going to also add a age version here as well, just to make it easier to understand how far along in the series we've gotten. So we're going to have age, and that's just going to take out the little v here. And finally, we have the age since the initial vintage. We've got the initial vintage itself, and we can just add those together to get the actual time period that we're looking at. So that's just going to be this quarter variable here. All right, so all I've kind of done here is start with this sort of little matrix that illustrates the dividend series for growth stocks. And I'm just converting that into this data set here. You can see that this just kind of makes explicit the fact that we are starting our series as of a certain time, and we've got the ages and the quarters of observation. So what I first want to do is just visualize what does this actually look like for a particular vintage, specifically 1990. This is going to be kind of an interesting one because it's going to span sort of the tech bubble here. So we can kind of see how the series for dividends kind of evolves around that time period. So I'm just going to call this one sample. And I'm going to start with that data set. I'm going to do this filter command. That's just a subsetting command. So I want to look at vintage quarter of 1990. I'm also just going to, for now, just add in a new variable that just recognizes that this is a dividend series. Okay, so I'm going to take this data set here. So you can see that this starts in 1990, and we're tracing the dividends every quarter after that. And I'm just going to plot it. So I'm going to take, this is a ggplot function that takes as an input the data that I'm starting out with, and just want to plot as the aesthetics the time dimension on the x-axis. So that is a quarter. The y dimension is going to be the cash flow that we generated. That's this kind of object here. And then I'm just going to turn this into a line. Okay. All right. And so here you can kind of see a little bit more concretely what exactly it is that we're talking about. So remember, we're starting from 1990, and I'm plotting the dividends that come from ownership of growth stocks over this period. So you can see, and each of these kind of points that makes up a line corresponds to the specific payoff in that particular quarter from a strategy that buys, holds, and only collects the dividends in that particular quarter. So if I just want to think about a portfolio that is just buying up all growth stocks and just kind of buying and holding, this is the aggregate kind of dividend series I would expect to get. So you see, it's sort of, unsurprisingly kind of increasing over time. We've got kind of the tech bubble years and then the period after that. So all of this is for one particular series, the growth dividend strips. And what we have in our project is a variety of different other factors. So we have this for the growth strip, but we have this also for value and the market overall, REITs, natural resources, infrastructure, so on and so forth. So these are all dividend series. The second type of factor that we're going to be considering here, though, is a capital gains strip. So dividends correspond to payoffs that you receive if you own stocks and you're just kind of harvesting the operational cash flow. But another thing you could do is buy a stock and sell it. So we also want to consider the possibility of returns that come from the realized capital gains of securities. And so to see that, we're going to plot now another series. This one is going to be the same, we're going to stick with growth, but now we're going to consider a capital gain strip for growth stocks. Okay, so we're going to just kind of copy over what we have here so far. We're just going to swap out, instead of looking at the growth dividend series, we're instead going to be looking at the capital gain strip for growth stocks. And so I'm going to call this growth gains strip. And we're similarly going to be looking at 1990. I'm going to call this capital gains. Also going to call this gains. Okay, so I've just selected another entry from our data set, which is just shifting our focus a little bit away from dividend strips towards capital gain strips. Now I'm plotting what that looks like. So a couple things to see here. So this is now going to correspond to a strategy that consists of buying growth stocks, holding them for some period of time, and selling them a precise number of quarters since the time you bought them. And one of the key things to take away from here is that this series shows a lot more of a bubble kind of around those 2000 bubble years, right? What that's sort of telling us is that dividends were kind of increasing during the kind of NASDAQ years, but really prices were going up much more. And so being able to separate out the cash flows from the capital gains is going to help us identify different types of factors associated with different strategies. Those that are more associated with the operational cash flow versus those that are associated with capital gains from realized market returns. And we kind of see this directly, that different strategies of either collecting the dividends or collecting the capital gains results in very different aggregate return characteristics. So just to make that really visible, I'm going to collect those two series that we just talked about, the growth dividend strips and the growth capital gain strips. I'm just going to plot them directly on top of each other to really highlight the contrast between those two series. So we had that as the sample data set and the sample gains data set. So I'm just going to create a combined sample here. That is the combined version of the first one and the second one, and then I'm going to plot that as well. So it's going to take the combined sample, same variables, but now we have a new entry here. Okay, great. So this really shows and highlights how our approach can be picking up different types of factors that have really different characteristics across the time series, right? This dividend series, shows an increase kind of in those tech years, but really it's the prices. It's really the realized capital gains from selling tech companies that's showing enormous returns during that period, whereas the dividends are not moving as much. So, put differently, the price dividend ratio is really changing around that time period. The reason, again, all this is valuable is our objective is to understand the risk and return characteristics of private equity funds and more generally of private investing vehicles. And to do so, we want to know whether the cash flows from these investments co-varies with what types of other factors, right? Are the cash flows going to look more like this capital gains factor here? Are they going to look more like the dividends component here? Understanding that will allow us to generate a replicating portfolio. And so we're going to be able to say that, well, if a venture capital fund looks a lot like this capital gains dimension, well, what it's really doing is stuff that's like selling tech companies, right? Whereas if it looks like this dividend series here, or if it looks like another factor, we may reach a different conclusion about the underlying risk characteristics of venture capital, private equity, any generic investment. So this sort of illustrates the basic building blocks that we're using for that task, the underlying dividend capital strips series. I'm just going to clean this up a little bit. So I'm going to get rid of this title here actually. So that's going to get rid of the title, and I'm going to add a overall title for this. So we're looking at realized capital gains and dividends for growth purchased 1990 Q1. We're plotting the cash flow, and we're looking across year. Okay, great. So that's the first plot that we have cleaned up a little bit here from our initial analysis. So the next thing I want to do, let me label all this. Dividend capital gain strip exploration. Next thing I want to do is look a little bit at our venture capital data. So this is to give you a sense of what the object is that we're trying to understand. We're trying to understand, we're going to take a specific example here of venture capital. That's a subcategory of the broader private equity universe we look at. And we want to understand specifically what are the risk and return characteristics? What are you expecting to get as an investor? Because it's a little bit of a black box. You give the venture capitalist $1, they give you back some amount of cash later. Then you want to know, did you do well? Did you do poorly? How much risk were you actually taking in that investment? Our approach is going to address this. And to see this, we're going to first start by plotting what does the venture capital data actually look like. Okay, so to look at that, we're going to start with this data set here. This is a data set that comes from Preqin on private equity funds across a variety of categories. And again, we're going to be focusing on venture capital. So let's create a venture capital data set. So we're going to take the underlying data set here is something called Fund Quarterly, and we're just going to subset on venture capital here. So just to give you a sense of what that's going to kind of look like, this is data at the fund quarter level. So we're looking across venture capital funds where the cash flows has already been aggregated to a quarter level. We're looking fund by fund, and we've got a look across time to see how much capital they actually return. So our first goal here is just to kind of visualize what cash flows look like in the industry overall. To do so, we're going to collapse these cash flows into a vintage year average. So all the funds that start in a given year are going to be collapsed in the same vintage. And then we're observing these funds in a panel, and so we're going to be looking across years to see what do the actual realized distributions look like to investors. This data is all post-fee, so this reflects the actual cash that an LP or investor is going to receive in this fund after they've committed $1 of capital to the GP, the general partner, to invest on their behalf. And so we're going to just plot here. So we've got we're going to create a new data set here that does this aggregation process for us. So we're going to start with this fund level data set. And we're going to use this command in R, just the group by command, to aggregate across the vintage as well as the year. So just like a summarized command in Stata. And specifically, we want the cash, the kind of aggregated cash that is going to be an equal weighted average across all funds. You could do it, evaluate or something, but we're just going to keep it simple here. Look at the cash. That is this variable here, net cash flow distribution rescaled. So it's rescaled to reflect a dollar's worth of capital contribution by the LP. Get rid of missing variables if we happen to have any. And so we're just going to keep these three variables: the vintage, the year, the cash variable, and we're just going to make it unique. So get rid of everything else, put it into all one data frame. And last thing I'm actually going to do here, I'm also going to filter. I only want to look at funds with a vintage of over 1990. Just get rid of a few of these very old VC funds here in the data set. Okay, so all I've kind of done here is start from real venture capital data, and I've just aggregated a little bit. So this now tells you, okay, if you invest in venture capital funds in 2001, again, something like an equal weighted average of a whole bunch of them, this is the cash you can expect to get year after year. These represent the distributions for investors. And so we just want to plot these just to kind of see what we can observe. So we'll do the same ggplot as before. We've got our data set. We want to look across year. We want to plot the cash. And we want to look across different vintages. So let's look across different vintages here. And we just want to align of all of those. Okay, great. So what this tells us is if you invest $1 into venture capital funds across all these different vintages, across all these initial years, this is the flow of cash that you can expect to return back to you. Obviously, a big thing that stands out here is the fact that those tech bubble years were phenomenal for the VC industry. That's when they were really returning a whole bunch of cash back to investors. Returns haven't been quite as good in recent years, but you see higher returns kind of in the mid 2010s. And again, the key question we want to ask ourselves is, well, what kind of risk were they taking in making these investments? Because you may be getting great returns here, but are those returns really as good on a risk adjusted basis? To do so, we need to know what the risk is. Our framework here is going to measure that risk based on a regression of these cash flows that I'm plotting here against our dividend strip factors. That's going to tell us which of these factors has a high beta, has a high factor loading against the realized cash. Let's determine what is the underlying risk that's going on here. So before I get to that, I'm just going to make this graph a little prettier here, just so that we can then save it down and then move on to the next step, which is that regression directly. So I'm just going to get rid of this entire legend here, actually. Legend, and we're going to add a title here. So these are venture capital distributions over time. We're looking at the distribution relative to a $1 committed. And we're looking across year. Okay, so that is our graph to show how the distributions for venture capital look over time. Okay, so now we want to move to the key aspect of the analysis, which is that risk measurement process. So what we're going to initially focus on is just a simple OLS regression. So we're going to start. So we are going to um, estimate the factor exposure of VC, and we are going to start by just doing OLS. So we have, I'm going to collapse these here. We have our third data set that we're going to look at. This one here is going to combine those dividend strips as well as the private equity cash flows. We're going to be focusing on the venture capital part. So let's create a venture capital specific data set, which is going to be starting from this this variable here. This is what we call the data fund quarterly.div that is filtered on venture capital. Okay, and just take a quick look at that data set. This is at the fund quarter level. So we're going to have observations here that reflect, cash flow distributions for different funds. We selected all venture capital funds, and so we've got a lot of observations here in this panel looking across time. What we want to do is measure how related these cash flows are to those factors. We're going to do just a little bit of cleaning first to make sure this data set is ready to go. We're going to just add a bonds here. So we have risky assets that will have the payoffs associated in our dividend strips. We'll have a risk-free bond asset that's just going to be one. That's going to be a risk-free asset you could use to match against the returns. And I'm just going to make sure we don't have we don't have any missing data here. Okay, so we're going to move directly from that to the OLS regression. So this is going to be a two-factor simple regression here. So in our regressions are run using this LM command. The cash is going to be on the left. So we're trying to match the cash flow from private equity funds. That you can just take from back here. So that's going to be our measure of the cash on the left-hand side of the regression. On the right-hand side, we now want to match against risk-free bonds and one risky asset, which here I'm going to stick with the stock gains strips. So the first one here is this age factor. So this is just basically a dummy for different ages, different years. And so a loading on this factor is just going to be the risk-free bond position. So this is going to, so it's kind of the constant term. And so to the extent that anything is loading on this, this is telling us that we have a generally constant exposure for that particular horizon. And so that's going to be picked up as a risk-free bond exposure. We're also going to consider a riskier exposure. We're also going to be looking across different horizons, but here we're going to have that gains strip associated with stocks. So this is basically just a market return. So this is the capital gains realization from buying the market, holding for different horizons, and selling to realize capital gains returns from the market overall. And so this is measured across all those different horizons, meaning all those different time periods experienced since when the fund started, allowing us to estimate basically a different beta for every single period from fund inception. So we don't assume that the beta of exposure with respect to risky stocks is the same across the fund life cycle, but we can actually allow these things to vary every single quarter from fund inception. And we're going to do this all on this venture capital data set that we have here. And so then I'm actually just going to take I'm just going to tidy this. This is using the broom function just to turn this into something that I can look at. Great. So this is the regression coefficients coming from that analysis in which we've regressed the private equity cash flows against our two factors, just a bond factor, just a constant, as well as a market return proxied for by that stock gains strip. So This is all coming from data, right? It's private equity data. It's all coming from this aggregate kind of stock data that's just divided up into and matched on the horizon. And so this tells us basically a replicating portfolio to match venture capital. It tells us, these are basically portfolio weights that we can go out and try to purchase in order to replicate the same cash flow as being produced by venture capital. So, to the extent that our replicating portfolio has certain characteristics, we think that's going to be applicable to venture capital as well, allowing us to open up that black box a little bit and understand how much risk we're actually taking with respect to this investment. We've got the portfolio weights here, we've got the coefficients here. We just want to visualize these. So, to do so, I'm just going to borrow a little bit of code that I have, which is just intended to clean these things up a little bit, clean these coefficients so I can plot them. So I'm going to do just another ggplot here where I'm going to take this output from the analysis, just this regression coefficient piece. I want to look at, now I'm going to look across age, the age of the private equity fund. I want to plot let's see, I've got the estimate here. That's the measure of the coefficient. And I want to look across different types of assets that I've got here. So I've got bonds here, and then I've got this kind of gains strip associated with stocks. So those are my two assets that I have here so far. Okay, so I'm going to look across those types that I have here, and I'm just going to plot those as lines. Okay, so what are we seeing here? So this is, again, one way to think about this is these are replicating portfolio weights. So if I want to generate the same exposure as a venture capital fund, what I can do is every time, instead of putting $1 into the venture capital fund, I go out and I build this portfolio exposure, which consists of a variety of different payoffs, 4 different horizons, in which I'm basically going to buy a bunch of stocks. I plan to hold them for a period of time, and I want to sell them off according to the schedule suggested here. So by selling off these stocks in this proportion, I will realize returns, and that cash, this model is telling me, is going to proxy on average for the cash flows that venture capital funds are otherwise returning to their investors. That's the part here kind of in blue that corresponds to the beta or the loading on the capital gain strip exposure across, horizon by horizon for each specific quarter or year from fund inception. So that was in blue, and you can see it's offset by a negative exposure here on bonds, which is basically like a short bond exposure. What this is sort of saying is that to get VC returns, you're sort of taking on a very leveraged exposure. So you're kind of shorting a bunch of bonds, you're buying an even higher proportionate amount of stocks, and those two things are going to allow you to replicate the portfolio that you're getting in venture capital, at least for kind of the first 10 years or so. After that point, the cash flows just start to look a little bit more stale, a little bit more on average proxy just by the regular bond exposure. So they stop being as covariant with respect to the market. So we can also look at what happens if I don't have that bond exposure at all, if I'm just investing in the stock market. So here, this gives you a little bit more of a hump-shaped curve to it. So this is if I eliminate the ability to go short at the same time. If I have a long only set of exposures, I get this relationship of factor exposures that are just with respect to the stocks, and that is again on average what's proxying for the returns in VC. I'm going to bring bonds back into it. I'm just going to clean this up here a little bit. So I want to, let's see, I want to get rid of this title here. So I'm going to do legend. Title is element blank. Then I'm going to do, this is the factor loading for VC funds, OLS only. I'm looking across years from fund inception. Okay, so if I do this now, I'm going to get back this little picture here, which illustrates what the factor exposure looks like in this two variable OLS context. Now, this OLS suffers from a couple of issues here. So one is, we've seen this kind of, sort of straddle in which you've got this very sharp negative return that's balancing out this positive stock return. Though there is some economic interpretation to this, namely that this reflects a sort of levered claim, you might be worried about really trying to replicate this using a long only portfolio, right? It might be kind of hard in practice to kind of get enough leverage or enough shorting ability to really replicate this. So, one thing we want to do is extend this to include a kind of long only framework, right? So we can have a purely long only replicating portfolio. The second thing, and this one's more important, is we really want to consider not just one risky security, but the whole factor list that we have, right? So we have a whole set of factors here. We've got this bond exposure. We've got that, we're looking at this stock capital gains exposure. We really have a lot of other factors here as well. And, we started off this analysis by thinking about, well, we've got this growth stuff. It seems like maybe this growth stuff is actually paying off kind of the same time as the venture capital funds. Maybe growth is associated with VC. I mean, that would be completely logical. Venture capital funds are investing into, quickly growing companies. It would make tons of sense if the underlying factor structure of their returns was associated with things that look like publicly traded growth stocks. That will make a lot of sense, but we need a framework to understand exactly how much can we quantify the contribution of these factors to growth stocks. To do so, we want to introduce all these different strips that we've talked about into the regression analysis, and we just really run into a big dimensionality problem. Right, we've got all these different horizons, we've got all these different factors, and so to address this, we're going to adopt a machine learning elastic net framework that's going to allow us to parsimoniously estimate these exposures across a really broad range of assets by doing a combination of a lasso approach that's going to kind of zero out a lot of stuff that doesn't make sense, as well as a ridge regression that's going to kind of do a little bit of a shrinkage estimation and lower the coefficients as well, so that we can get a more sparse representation of the factor structure in ways that we think are going to proxy for the risk that these funds are actually taking. Okay, so we want to run this elastic net machine learning approach to understand factor exposure for all these different strips taken at once. So to do that, let's create a new code block here. So this is going to be the elastic net section of the code. And this is going to require a little bit of prep because the commands that we're going to use for machine learning actually require the data to be set up in a matrix. So we're actually kind of returning the data back into kind of what it started as. And we're going to need to put the data in that format before we can actually run the machine learning algorithms. Okay, so to do so, we're going to first reshape the y variables as well as the x variables. So this is going to be a subset of the data where we start out from our venture capital data set. We just want to look at the y variables here, the cash flows. So that is here, and we just want to want to pick that variable and turn to a matrix, right? So we want to do this similarly for the x variables. This is going to get just a little complicated because we want to just kind of select across all the kind of the sort of dividend and capital strips that we have. And so I'm just going to use some pre-existing code that sort of implements this. And I'll talk about what it is, and but otherwise I'm just going to copy over what I have already. So we're going to start off with this kind of data set we have, and this initial step here is just kind of creating some dummies for the different ages. So we just want to select out blocks of the code and see, okay, it's first year, second year, third year, etc. These are the same model list as we have above that just sort of allows us to know what to loop over in selecting the variables, and this is basically just picking out all of the different dividend strips from the data and converting it into a matrix. So just a little bit of a helpful here. All I've kind of done at the end of this process is just kind of collect together all the dividend strip data. We're going to regress that against the private equity cash flow data here. And this here is just picking up the data specifically, right? So we've got this bond exposure, we've got exposure for other kinds of assets here. This is just collected the same factors that we have into a matrix. So once it's in a matrix, we can then use the machine learning algorithm. Okay, so I'm going to then run the ML model. So I'm going to use this package here, glmnet, that's going to include this function here called cva.glmnet. What this is going to do is basically run across a lot of hyperparameters, specifically the hyperparameters for the lasso regression, as well as the hyperparameters for the ridge regression. And it's going to just kind of do that process and pick the hypertuned best parameters. I'm going to have to select the number of folds, so the number of kind of leave out samples that this algorithm is going to use to try to pick the best model. So I'm going to call this model the penalized model. This is a CVA glmnet command. That's from this glmnet utils function here. So it's going to take as an input, I need the X variables. So I just generated these. These are just all the dividend strips matched to the fund data. I'm going to need a Y variable. That's just the cash flows for these venture capital funds. Then I'm going to need to set a parameter known as alpha. So what I'm going to do here, this is something that's pretty standard. I'm just going to kind of run across run across the range 0 to 1 here. So I'm going to go from 0 to 1 here. And then I'm going to just set the number of folds. So I'm going to do 10 folds here. So I'll have one leave out sample for that's just kind of the number of folds we're cutting the data across. I'm actually going to also require that this be a long only series of portfolio exposures. So we can't have any of the coefficients go below 0. This is easy enough to change if you wanted to also accommodate for these kind of short, long offsetting positions. And I'm actually going to also get rid of the intercept because I've accommodated for that with this kind of bond thing over here. Okay, so I've got this specification. I'm going to let this run, and this is just going to take a little bit of a second here to actually finish running. Okay, so now that this is finished running, take a quick look here. This isn't necessarily super informative, but basically see these are kind of the parameters we're running across here. We've got some kind of model outputs here across the different runs. And we basically just want to pick out the best one, right? We just want to pick up the optimal kind of hyperparameters here. And we're going to use this to determine what the factor loadings look like at the end result of our elastic net regressions. So I'm actually just going to copy some existing code that is going to look at this, and I'll just explain what it is that I'm doing. So first, I'm just looking across these a number of alphas. Again, that's one of the sort of things I had to kind of pre-specified here. I'm loading a data table, and here I'm just trying to pick up the best parameters. Just looking across here to pick up the best values of the lambda and of the alpha, and what the minimum mean squared errors is that those correspond to. So this has basically given me an alpha, a mean squared error, a lambda here that correspond to the parameters that I'm going to then run with in my specification. Because it's hypertuned these, it's determined which are the best kind of scaling parameters from this overall process, right? And it's really interesting to do, and we do this in the paper, to look robustness across, well, what would the kind of the results look like in the other sort of parts of the state space. But we're first just going to start with doing the model estimation on this kind of set of best parameters. So to do so, we had run the CVA glmnet, so that was the kind of cross-validated approach. We're then going to take the kind of the best fit elastic net model. So this is using not the CBA.glmnet, but now just the glmnet function itself. So it's going to we'll call this the penalized model. And so we'll do a glmnet where we're going to do same x, same y, same restrictions here on like the lower limit thing to make this like a long only. But now we're going to actually specify the alpha that we're going to be using here is not like running across a lot of different parameter choices. We're actually picking the best, the best alpha here. We're picking the lambda. It's going to be the best lambda. And then we're also going to impose this intercept requirement here. So this one should run a lot more quickly. So now we basically have our model fit after having chosen the lasso and the elastic net kind of coefficients. One thing that I'm going to do just for the purposes of visualization is to actually run this, do the same model, but get rid of this lambda requirement. So I'm just running a version of the model where I'm not pre-specifying that lambda. What that's just going to allow me to do is just plot to see what the coefficients actually look like. So this is just sort of showing you how many coefficients remain in the model across different choices for this L1 norm here. And so you just sort of, can just get a little bit of a sense here. Well, you sort of change the tuning parameters and you have more or less variables, coefficients actually dropping out of the model here. So there's a lot more robustness that you can do to think about what exactly are the variables that come in and out. They're just kind of giving you a very rough sense for how these approaches work at trying to trim the model down a little bit and make it just a little bit more tractable. But what we're going to do is take the kind of best fit model here and just visualize it. So we just want to see what those coefficients actually look like. And to do so, I'm again just going to take some pre-existing code that I have that is just here to simplify my life a little bit and make it easy for me to see what is actually going on. Okay, so I just want to plot what's going on here in the data. So I'm going to look across the object here. I want to see I'm going to do the same kind of graphing analysis I did for the OLS model. I'm looking across the age of the fund. I'm looking for the value, and I'm looking across um, different types of factors here. Okay, we've got the coefficients here. Let me just give you a sense of what those look like again. So we've got those different coefficients for age. To the extent that the variable isn't even picked up in the final model, it's going to be zeroed out. And we have these strips again for different types, broken out also by whether they're dividend or capital gain strip. So we're just plotting what these different strips look like. One more step we want to do here is really separate out whether these are the dividend or gain strips. And we're also just going to make the points here a little bit larger so we can see them. And I'll talk about what we have put together. Okay, great. Okay, so and let's finally, last step, get rid of the okay, great. So what are we looking at here? So this is the factor exposure that we get after the elastic net process. Relative to the OLS, this makes a couple of key differences. One is that we are requiring all these exposures be long only, and we're also including a much broader set of factors. We're including a lot of different factors here in both dividend and gains strip exposures. And this analysis kind of reveals one really interesting thing, which is that if we look across the fast exposures, the one that really seems to dominate for a lot of the series is this growth gains component, the red with the dotted lines. So what that tells us is the factor exposure of venture capital funds loads very heavily on something that looks like buying growth companies in public markets, holding them across different horizons, and then selling them. That the resulting capital gains exposures, when summed up across the different horizons, lines up to match with the replicating portfolio for a venture capital fund. This is a really important way now of understanding that risk return characteristic profile, because we can use this factor structure that we've come up here to now do a lot of other things. So what we do in the paper is think about the expected return of venture capital. We think about the alpha as well. So given that we think this is the factor exposure, are venture capital funds actually delivering you alpha with respect to this particular factors exposure? To do that particular analysis, we need to use not just the dividend series, but we also need to know how much they cost. And so we also have a series of prices that correspond to all these different strips that tell us how much you have to pay today in order to actually purchase this exact exposure. Our pricing allows us to then contrast the cost of the replicating portfolio with the cost of the standard venture capital fund to determine whether there is alpha or not. So we do a lot of these other things in the paper, but this code tells you kind of the basic framework for how to work with the dividend strip data, the capital gain strip data, how to run simple regressions of uh, those strips against realized cash flow data, and how to even expand that a little bit beyond just a simple OLS model to incorporate a lot of different factors all at once.